Today, I will explain topics related to financial statements, audit. In the audit of financial statements, the subject matter are the financial statements. And generally, the components of a complete set of financial statements are 1. Statement of financial position as of period end. 2. Statement of comprehensive income for the period ended. 3. Statement of changes in equity for the period ended. 4. Statement of cash flows for the period ended. 5. Notes to financial statements as of and for the period ended. And 6. Statement of financial position at the beginning of the earliest comparative period if there is a change in accounting policy, a prior period error, or a reclassification. Like I said, management is responsible for preparing the financial statements. And in preparing the financial statements, management make assertions. And assertions are representations by management, explicit or otherwise, that are embodied in the financial statements. And these assertions are categorized into 3. First category of assertions are assertions related to classes of transactions and events for the period under audit. 2. Assertions related to account balances as of period end. And 3. Assertions related to presentation and disclosure. Let's have the first category. Assertions pertaining to or related to classes of transactions and events for the period under audit. Management asserts that, transactions and events that have been recorded have occurred and pertain to the entity. This management assertion is known as the assertion of occurrence. Next, management asserts that all transactions and events that should have been recorded have been recorded. This management assertion is known as the assertion of completeness. Next, management asserts that the amounts and other data relating to recorded transactions and events have been recorded appropriately. This management assertion is known as the assertion of accuracy. Next, management asserts that transactions and events have been recorded in the correct accounting period. This management assertion is known as the assertion of cutoff. Next, management asserts that transactions and events have been recorded in the proper accounts. This management assertion is known as the assertion of classification. So these are the management assertions related to the classes of transactions and events for the period under audit. And these assertions are embedded in the financial statements. Again, what are these management assertions pertaining to classes of transactions and events for the period under audit? You have occurrence, completeness, accuracy, cutoff, and classification. Now, management also make assertions related to account balances as of period end. Let's have the first one. Management asserts that assets, liabilities, and equity interests exist. This management assertion is known as the assertion of existence. Next, management asserts that the entity holds or controls the rights to assets and liabilities are obligations of the entity. This management assertion is known as the assertion of rights and obligations. Next, management asserts that all assets, liabilities, and equity interests that should have been recorded have been recorded. This management assertion is known as the assertion of completeness. Next, management asserts that the assets, liabilities, and equity interests are included in the FS at the appropriate amounts, and any resulting valuation or allocation adjustments are appropriately recorded. This type of management assertion is known as valuation and allocation. So these are management assertions pertaining to account balances as of period end. Okay, again, to recap, these assertions are existence, rights and obligations, completeness, and valuation and allocation. Now let's have the third category of management assertions. Management make assertions related to presentation and disclosures in the financial statements. Let's have this one. First one. Management asserts that disclosed events, transactions, and other matters have occurred and pertain to the entity. This management assertion is known as the assertion of occurrence and rights and obligations. Next, management asserts that all disclosures that should have been included in the FS have been included. This management assertion is known as completeness. Next, management asserts that financial information is appropriately presented and described, and disclosures are clearly expressed. This management assertion is known as the assertion of classification and understandability. Next, management asserts that financial and other information are disclosed fairly in an appropriate amounts. This management assertion is known as the assertion of accuracy and valuation. So these are the management assertions related to the presentation and disclosures in the financial statements. Again, these are occurrence and rights and obligations, completeness, classification and understandability, and accuracy and valuation. Let's have the acronyms so that hindi mo makalimutan. Now, assertions related to transactions and events for the period under audit, you have COCA. Completeness, occurrence, cut-off, accuracy, and classification. For the account balance, you have received, rights and obligation, completeness, existence, and valuation. For the presentation and disclosure, you have, what is letter C? Completeness. Then you have occurrence and rights and obligation. The letter C, classification and understandability. And letter A, accuracy and valuation. COCA, receive, COCA. Ayan, para hindi mo makalimutan. So these are the three categories of management assertions. Okay? Now let's proceed to the auditor's overall objectives. In the audit of financial statements, the overall objectives of the auditor are to obtain reasonable assurance whether the financial statements are free from material misstatement, whether due to fraud or error, to enable the auditor to express an opinion on whether the financial statements are prepared in all material respects in accordance with an applicable financial reporting framework, and to report on the financial statements and communicate as required by the Philippine Standards on Auditing in accordance with the auditor's finding. Here is an illustrative auditor's overall objectives. The auditor performs audit procedures in order to gather sufficient appropriate audit evidence and to obtain reasonable assurance and reduce audit risk to an acceptable level. Thereafter, the auditor forms an opinion about the fairness of financial statements, and this opinion is embodied in a written auditor's report, okay, that is attached to the financial statement submitted to various interested users. Okay? Let's have audit risk and reasonable assurance. The formula for audit risk is inherent risk times control risk times detection risk. Okay? So that is the formula for audit risk. IR times CR times DR equals audit risk. IR and CR, or inherent risk and control risk, are two functions of risk of material misstatement. What is risk of material misstatement? This is the chance that the FS are already materially misstated before the audit begins. Okay? Now, IR and CR, okay, are risk that is attributed to the management. The auditor cannot change this, okay, the level of this risk. Okay? What the auditor can adjust is the level of detection risk. Okay? Detection risk is a dependent variable. Detection risk, the degree of detection risk, depends on the assessment, the auditor's assessment of the risk of material misstatement. These two risks are attributed to management. These are already present even before the auditor was hired to do the audit. Detection risk is the risk that can be adjusted, okay, that can be planned by the auditor. This is the risk that is which degree is under the control of the auditor. Okay? So, detection risk is the dependent variable among the risk comprising the formula of audit risk. Detection risk is the dependent variable because it depends on the degree of detection risk that the auditor is willing to accept depends on his assessment of the risk of material misstatement, which consists of, or which is a function of, IR, or the inherent risk, and CR, or the control risk. So, audit risk equals IR times CR times DR, or RMM times DR. Okay? RMM is the chance that the FS already misstated or materially misstated even before the auditor was hired to do the audit or before the audit begins. DR, or detection risk, is the chance that the auditor fails to detect material misstatement. This is attributable to management. The auditor can do nothing about this. What the auditor can do is to adjust, okay, adjust the degree of detection risk, or DR. Okay? Audit risk is the chance that the auditor's opinion is inappropriate when the FS are actually materially misstated. Audit risk is the risk or likelihood that the auditor gives an inappropriate audit opinion when the financial statements are materially misstated. We call that audit risk. Like I said, the formula for computing audit risk is risk of material misstatement multiplied by DR. RMM is a function of IR and CR. Now, let's proceed to the auditor's opinion. Okay, embodied in the report. The auditor's report shall be in writing, hard copy format, or an electronic medium. The report contains the following opinions depending on the outcome of the engagement. Now, these are the opinions, okay, that may be contained, okay, or included in the audit report. You have unmodified, also known as unqualified or clean opinion. The opinion expressed when the financial statements are prepared in all material respects in accordance with the applicable financial reporting framework. You call it unmodified or unqualified or clean opinion. Then you have the modified opinion. 3 types of modified opinion. You have qualified opinion. Here, in qualified opinion, the auditor is satisfied that the FS are presented fairly except for a specific aspect. Okay? Then you have the second type of modified opinion, adverse opinion. Here, the auditor does not believe that the FS are fairly presented. Next, you have disclaimer of opinion. The auditor does not know if the FS are fairly presented. Disclaimer. Okay? Let's have this example. Now, ito si Nadine. Okay? Kakahiwala niya lang kay James Reed. Now, he's looking for a guy. Gusto niya yung guy na kamukha pa rin ni James Reed. Okay? Okay, James Reed. Ito si James Reed. Okay. Ito si Nadine. Tawagin natin siya sa pangalang Victor. Okay. Gusto ni Nadine makahanap ng lalaki na kamukha ni James Reed. Okay? So, Victor claims or asserts that he looks like James Reed. Okay? Nadine, okay, ask for help, okay, from a friend. Okay? Si Asuncion. Yan. Okay? Now, Asuncion here represents the practitioner. Si Nadine dito, user. Si Victor dito, responsible party. Si James Reed dito, yung mukha ni James Reed, that represents the criteria. Okay? Now, Asuncion was asked by Nadine to give her opinion whether Victor looks like James Reed. Okay? So, sabi ni Asuncion, okay? Sabi niya, yes, Victor looks like James Reed. Ang tawag sa opinion na yon ay unqualified, clean, or unmodified. Okay? So, sabi niya, yes, Victor looks like James Reed. Okay? Grabe. Si Nadine sabi niya, oh my God, I already found a replacement for James Reed. Okay? I like you, Victor. Thank you, Asuncion. Ayan. So, ang tawag sa opinion ni Asuncion is unqualified or clean or unmodified opinion. Okay? Next, pag sinabi ni Asuncion na hindi niya kamukha, malayong malayo, hindi niya kamukha, ang tawag doon is adverse opinion. Okay? Hindi kamukha ni Victor si James Reed. Okay? So, sabi ni Nadine, ayoko na sa'yo, Victor. Okay? Sabihin na nating hindi pa ako nakapag-move on kay James Reed. Kaya na ako naghahanap ng jowang kamukhang-kamukha ni James Reed. Ayan. So, ang tawag doon, adverse. Next, sabi ni Asuncion, kamukha ni Victor si James Reed, except sa ilong. Ayan, except sa ilong. Sobrang ganda siguro ng ilong ni James Reed, hindi makuha ni Victor. You call that a qualified opinion. Except for, Okay? Except for. Yun. So, except sa ilong, you call it qualified opinion. Next, sabi ni Asuncion, no comment. Sabi ni Nadine, anong ibig mo sabihin? Sabi ni Asuncion, basta no comment. That type of opinion is a disclaimer of an opinion. Okay? Opinion, pero walang opinion. Yun. Disclaimer of an opinion. Okay? Balik tayo. Si Nadine, okay? Si Nadine here is the user. Okay? Now, si Victor here is the responsible party. Okay? Yung subject dito ay naghahanap. Okay? Naghahanap dito ng kapalit ni James Reid, si Nadine. And he's looking for somebody who looks like James Reid. Okay? Then pumasok si Asuncion to give the opinion. Asuncion here represents the practitioner. Yung mukha ni James Reid represents the criteria. Okay? Like I said, yung opinion ni Asuncion, sabi niya, Victor looks like James Reid. That is unqualified, clean, or unmodified. Yung sinabi niyang Victor doesn't like James Reid, that opinion is an adverse opinion. Yung sinabi niyang Victor looks like James Reid except for the nose, ang tawag sa opinion na yon ay qualified. Nung sinabi ni Asuncion na no comment ako dyan, okay, ang tawag doon ay disclaimer of an opinion. Okay? So, these are the types of opinion. To recap, unmodified, unqualified or clean opinion. Next, you have modified opinion consisting of a qualified opinion, an adverse opinion, and a disclaimer of opinion. Okay? Now, gathering audit evidence and documentation. From the start to end of audit, the auditor gathers and accumulates audit evidence and documentation that supports the opinion to be expressed. How do auditors maintain the quality of audit? Quality audit means that the audit was performed in accordance with relevant ethical, professional, legal, and regulatory requirements. What are the relevant ethical requirements? You have PUCP. Ayan. Mas masarap sigurong pakinggan yung PICPO na lang. Okay? Okay? PUCP. Ayan, PICPO. Ayan, no? So you have integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. Kaya nagpapatawa ako because that is one of the relevant ethical requirements. Due care. Ayan, joke lang. Okay? Due care yan. Due care, not joker. Okay? So, again, what are the relevant ethical requirements? Pwede may pick po. Professional behavior, integrity, confidentiality, professional competence and due care, and objectivity. Okay? In addition to fundamental principles, the code also requires professional accountants to be independent when performing audits, both of mind and appearance. What is professional judgment? Ito, ilang beses na itong lumabas sa board exam. Professional judgment is the hallmark or trademark of auditing. Professional judgment is the application of relevant training, knowledge, and experience within the context provided by auditing, accounting, and ethical standards in making informed decisions about the courses of action that are appropriate in the circumstances of the audit engagement. Professional judgment is essential to the proper conduct of an audit because it enables the proper interpretation of the relevant ethical requirements, the Philippine standards on auditing, and in making informed decisions. Professional judgment is necessary in particular regarding decisions about materiality and audit risk. Hirap mag-decide, okay? Hirap mag-decide about materiality and audit risk, okay? Without professional judgment. Okay? Also, professional judgment is necessary in making decisions about the nature, timing, and extent of the audit procedures. Furthermore, professional judgment is necessary in evaluating whether sufficient appropriate audit evidence has been obtained. Professional judgment is also necessary in evaluating management judgments in applying the applicable financial reporting framework. Okay? Professional judgment is necessary in drawing conclusions, for example, the reasonableness of the management's estimate. Here are the steps in the application of professional judgment. Step 1, identify what is the issue. Step 2, gather relevant facts. Step 3, review relevant auditing, accounting, and ethical requirements. Step 4, analyze the issue. And step 5, conclude and document the decision made. Okay? Apply professional judgment while maintaining professional skepticism. What is professional skepticism? An attitude that includes a questioning mind. Okay? Being alert to conditions which may indicate possible misstatement due to fraud or error, and a critical assessment of audit evidence. Okay? Professional skepticism includes being alert to, for example, audit evidence that contradicts other audit evidence obtained, information that brings into question the reliability of documents in the responses to inquiries to be used as audit evidence, conditions that may indicate possible fraud, and circumstances that suggest the need for audit procedures in addition to requirements of PSAs.